Hey, what it do, world? Welcome to the Market Banter podcast. You are rolling with me. I'm Dion Rabowen, financial journalist. I write the Axios Markets newsletter, and of course, the king of comedy,
Wow.
Dan Enfield, and a working stiff. You know, he's out there working hard on the grind, doing it every day, just trying to make sense of this crazy old world like you are. This is the people's financial show. We're not here for them. We're here for you. Keeping it 100 and keeping it honest. Doing our best to no,
that was a 10, but you know,
it's actually one, but it's
whatever.
All right.
That's right. Yeah, that's funny.
There you go. Anyway, it's the people's financial podcast where, we're doing all that good stuff. And this is a very interesting week. We got a lot of argument about inflation. And this $1.9 trillion potential stimulus bill that the Biden administration is talking about. We will be talking about that with our very esteemed and very knowledgeable guest on the program today. And yeah, Dan, what's on your mind right now?
Thinking about launching a new currency called Dion Coin. I think if I launch that, I'll probably get a few $1 billion I can convince people to give me.
Wait, sorry. Why are you gonna name your cryptocurrency after me?
I think it's kind of like it's close enough to the Dogecoin thing that people may think it's the same. So that it's kind of like that Eddie Murphy movie when he runs for office. I forgot. I think it was Boomerang when he runs under the name.
At all.
Which one was it? Distinguished Gentleman.
Yeah, maybe it's definitely not.
Okay, it's the one where he runs for office because he has the same last name as the guy before, and people just like, oh, okay, it must be the same guy.
Yeah, who's that guy I always vote for?
Yeah, exactly. Yeah, so I think it's close enough that I think people would just buy it at this point.
I don't think it is. I think that's a terrible strategy, and it's probably not going to work out for you. Anyway, our guest Hannah Lang is a reporter for American Banter. She's going to walk us through all that good stuff with inflation risks, the stimulus package, central banks, and how they're feeling about that. And we got some good stuff in there about inflation, so we're going to talk to her about that a little later on. Dan, I know you're really excited about Tom Brady winning another Super Bowl. So that's the thing that's happening right now.
Right.
How did you enjoy the big game?
I turned it off at halftime. I had a feeling the Bucs were going to win. Good for the city of Tampa. I think they are the losingest franchise in the history of sports. I'm pretty sure. So I mean, wow. Yeah, good for them that they get a Super Bowl. I think it's their second one. So. Congrats to them. They get to be champions for the moment. Plus, I'm also sad because, I love throwing out meaningless stats. They were the first home team to ever have a Super Bowl in their stadium, at the time of them being in the game. So that stat's now out the window. So, yeah.
Yeah, they can stop saying it.
They can stop saying it now.
I stopped watching football years ago, but I remember when I used to watch it, they would always say, if some team was playing well and the Super Bowl was going to be in their city this year, they'd be like, well, he's trying to become the first quarterback to play the Super Bowl in his home city.
Right. Yeah,
they can stop saying that, which will be nice. And actually, I bring up the Super Bowl just to make this quick point, which is that there's always this talk, and this year it was like, oh, no, the city of Tampa is not going to see the giant windfall of profit gains from the Super Bowl that you normally would because of COVID. And I would like to point out there is no windfall profits from the Super Bowl. That is a lie that's been perpetuated for a very long time by the NFL and local politicians who want to be able to say that they brought the Super Bowl and they brought these hundreds of billions or millions of dollars and, economic impact to their city when they didn't. The economic impact just moves. It goes from your normal things, restaurants, bars, jewelry stores, retail, to hotels and to NFL stuff. It just moves from here to over here. All the visitors, all the visitors just crowd out the spending from the local population that either leaves town to get away from the Super Bowl or doesn't go out because there's all the madness of the Super Bowl and stays in at their house. If they do go out, they go to NFL stuff, which is not generally helping the local city's economy at all. So I just wanted to put that out there for people who don't know that that's a thing. I've written on this topic a few times. I think it's out there. The information's out there.
Does the Olympics work the same way? Is it still kind of a sham too, or
Olympics works the same way. It's a giant sham, and countries spend hundreds of billions of dollars that they could use to help the poor, fix their infrastructure, generally improve the economy, and they use it to
Right.
build stadiums, which give people temporary jobs, which is nice, and then those temporary jobs go away, and
Right.
you know,
I mean,
and
you
they're
probably
back to
say
where
the
they
Olympics
were.
is even worse because at least with the Super Bowl, you're using an existing stadium. Olympics, you build these
Right.
stadiums that are only used
Yeah.
one time a lot of times.
Right, yeah, which is why the U.S. Olympics was probably one of the most successful Olympics, because we just had all the stadiums and we didn't build
Right.
it. We're just like,
Right.
yeah, no, just go play over there.
Huh. It's funny.
Yeah. So anyway, I just wanted to make sure and say that, because this is a lie that people keep telling. Every year you get this, if you're a reporter, you get this thing in your inbox about how much the Super Bowl's economic impact is increasing this year and how lucky the city is. And it's all just a giant lie. And that's been proven. My man Neil DeMoss, he wrote the book Field of Schemes. He
Ooh.
gets into this and breaks out the numbers and all that. He's a smart guy. If you don't know about Neil DeMoss, follow Neil DeMoss. It's spelled like DeMause. One of the smartest guys out there. Anyway, he follows all that good stuff. All right, let's get into our interview with Hannah.
Let's do it.
We got her on the line. Hannah Lang, reporter at American Banker. And like I said, we're going to be talking about this $1.9 trillion stimulus bill. We're going to be talking about the potential for inflation. Larry Summers made a big to-do about, oh no, the Biden plan is going to destroy the economy with inflation. And we're going to talk to we're going to talk to Hannah all about that. All right, here on Market Banter, we welcome in Hannah Lang. She is a reporter at American Banker. Hannah, thanks so much for being with us.
Thanks for having me.
So look, let's jump right into kind of the topic du jour, which is inflation. You report a lot about what's going on with central banks and all that. What is the take right now that's happening with regard to this big fight over, is inflation going to come back?
Yeah, so I think the fight really centers around the Biden team's 1.9 trillion stimulus package that they're
Right.
pushing Congress to pass. And there's basically this push and pull between officials who have warned the government that there are more risks to underdoing it on the fiscal stimulus side than overdoing it, and those that believe 1.9 trillion could put us over the edge and lead to higher inflation that would be hard to tame. There's this real conflict, and it kind of comes at a time that we're rethinking how inflation works. After the 2008 financial crisis and the stimulus package that was put out then, a lot of people worried that we would see a rampant rise in inflation, and that really never came to pass. In fact, we had a kind of a persistently slow recovery, and the Fed has had a hard time actually meeting its target for inflation since then. We're not quite sure how this relationship works, and the Fed is actually looking to let inflation run a little hot for a period now in order to kind of make up for years of low inflation. And so I think from the Fed's perspective, they would almost welcome higher inflation.
Right. They keep saying that.
Yeah, they do. And it might seem kind of counterintuitive, but the Fed, inflation can really help a lot of people. It can open up more job opportunities. It can, raise
inflation
wages.
can help
Yeah,
a lot
that's
of
news
people.
to me.
Yeah. Yeah, but the Fed also wants to be able to kind of control inflation and show that it can control inflation. And so it's important to them that they meet this target. But yeah, I think the Fed is not worried. They say that they're not worried about the
Right.
1.9 trillion stimulus package kind of pushing us over the edge. So we'll see.
You've talked to people on both sides of this issue, I presume. What are the people making the case that this will be inflationary saying? I mean, because as you talked about, it's been a decade since QE, and everyone thought when we did, the Recovery Act, the big stimulus in '08, which now looks like, a footnote. I think it was $831 billion, which, nothing at this point. But, what are the folks saying now who say that this will be inflationary? This time is different.
Yeah, so there's this kind of weird combination of factors going on here, and one is the fact that this is not a financial crisis in nature. This is a public health crisis. It's a pandemic. And because of that, there is likely a lot of pent up demand. People aren't traveling, people aren't, going out and spending money. And so a lot of people are forecasting that the second half of this year, assuming everything goes well on the vaccine front and things start to open up more, that we'll see kind of a surge in the flow of money as people, start to become more comfortable kind of doing things that the last year hasn't allowed. So that's one factor. And then the other factor on top of that is all of this, the stimulus package. And it's not just the 1.9 trillion that is being debated right now. That's in addition to the 900 billion package that Congress passed in December. And that's in addition to the CARES Act, which, 2 trillion. And so, there's...
And then there's also the potential for an infrastructure bill, right, down the road.
Yeah, exactly. The Biden administration has talked about wanting to do an infrastructure package as well, and maybe even, things on climate change. So, there's these combination of factors that really weren't present last time. And I think the financial crisis, the stimulus package was only 800 billion. Granted, a lot of people have blamed that for a slower recovery, but at the same time, this is spending that we really haven't seen since World War II, and some people are worried about where that might put us in the end.
So you're saying that there's a feeling that the economy could rebound in the second half of the year, so why burn $1 billion basically, or 1 point whatever it is? Yeah.
Whoa,
I'm sorry, 800 billion.
No,
whatever,
we lose $1 billion. They lose $1 billion in a day.
Right.
$1 trillion.
This podcast is actually called Billion Schmillion. I don't know if you knew that.
Well, no, yeah, it's true. I mean, people's savings have gone up over the past year on
average.
Right,
because where is there to go? What is there to do?
Yeah, exactly. there's no traveling.
It's like literally nothing going on. It's crazy.
Yeah, so, when you think about it, people ask, oh, what are you going to do when the pandemic ends, which is relative. But, the answers are, take a huge international trip to, going to see friends and family that you haven't seen. I mean, a lot of it is kind of related to travel and, going to concerts and doing these big things.
Yeah. How much of that do you put as being part of the rally and things like Dogecoin and GameStop and things like that? Have you looked at that at all?
Yeah, I think that I don't think that really interacts much here, except for maybe there is a narrative that has been present since 2008, which is, Wall Street versus Main Street. And I think a lot of people have this, they call this recovery a K-shaped recovery. I mean, we're seeing a quick rebound for people at the higher end of the income spectrum and a much slower recovery for people at the lower end of the income spectrum. And I think some people are really feeling that. And I think there is something to be said for the narrative of kind of stick it to the man, let's show Wall Street, who's boss. But I don't think that I wouldn't count on that having any interaction with inflation in the second half of the year. As far as savings.
Oh yeah, we were switching questions. We were moving off of inflation.
Okay. But no, the saving, I think it's a combination of savings and people are bored. People are bored at home. I think I've heard that there's a lot of euphoria in the market right now, and apps like Robinhood have really democratized trading for the everyday person, and and there are stories of people using their stimulus checks or economic impact money to buy things like GameStop, and
Yeah.
We'll see if
yeah,
that
actually,
continues.
I don't know if you saw this, the survey from the Conference Board. I just wrote about it this morning in the Markets newsletter. But Conference Board shows spending on housing is down 18%. The things we would call like essential or necessary goods is down. Spending on all those things we talked about, going out, going on trips, all that is down. Spending on everything is down. Savings is down. But stock market is up. People putting money in the market, whether that be stocks or mutual funds. And also, I should point out, and I want to make sure I say this, that most of the people who are putting money in the stock market are actually putting money in index funds and mutual funds and buying companies like Apple and things like that. They're not usually buying GameStop and AMC, and that's not what most people are
Right.
doing. But you have seen a rush of people going into the stock market because they just don't really have anything else to do with their money.
Yeah, and I think there's also an interest rate factor here. I mean, interest rates
Right.
are near zero and they're expected to stay there for years. And so all of a sudden, you're just not getting the same kind of returns from high yield savings accounts or even in the treasury
Yeah.
market, which is, a historically safe investment. And so the stock market has kind of become all of a sudden the best place to get, a bang for your buck.
Yeah, yeah. I mean, it's what Wall Street has been doing for the past 10 years. It's just that now Main Street is like, oh wait, I can actually earn some money with my money. Why have I been keeping it in this savings account that was paying, my Marcus account, which is supposed to be the high yield account from Goldman Sachs, was paying 0.5% interest, which is like insulting. I feel like a person that got slapped in the face every time they send me one of those emails, like your interest rate has been changed.
Yeah, no,
So yeah,
I've seen the same thing. I know. I think in most high yield savings accounts, it's less than 1%, and that's you're just not really going to see a lot from that, and that's probably going to stay that way for a while. And so I think the stock market has become more attractive because of that as well.
yeah. Dan, you want to ask another question?
Hey, back to your earlier thing, like, how does inflation help people? I didn't. I've never heard that before.
Well, I mean, I don't think inflation helps people by and large. And inflation can obviously be very, very harmful. But a little bit of inflation, modest inflation, there's theories that, that opens up more, yeah, just a little. There's theories that, really can push up wages and, can be helpful to, people looking for jobs. All of a sudden they're kind of in the driver's seat. So that's why the Fed wants a little bit of inflation. And, it also, there's theories that we need some inflation for economic growth and to keep growing as a country.
Right, right. You want that 2%. But now it looks
Yes.
like we're moving towards that 2.5, maybe 2.7% inflation, which my man Jim Bianco pointed out on our other podcast would be the highest inflation we've had in 30 years. Last question I'll leave you with, Hannah. What's your take on where we are? I mean, it looks like this $1.9 trillion stimulus is going to get done because Democrats are going to do it without any Republican support. The infrastructure bill obviously is still up in the air, but it seems like the Republicans are kind of reverting back to that whole, oh God, the budget, we can't. And central banks, I just watched Christine Lagarde this morning say that she's not worried about inflation at all. That seems to be where the central banks stand on this. Where do we go from here?
Yeah, so I think you make a good point that the Democrats really are in the driver's seat here, and they've made that clear. And so have Biden and Treasury Secretary Janet Yellen. They've all said they're not worried about inflation, and they have no reason to be. And the Fed would even welcome some higher inflation right now. But I think it will be interesting to see what elements of the stimulus package are get to be more targeted, kind of in somewhat of a compromise with Republicans, maybe to get some of them on board. I mean, I'm thinking of the $15 minimum wage proposal in there that Republicans have argued against, and even some of the tax credits that would only last through this year. I think that some economists would feel that the 1.9 trillion number isn't bad necessarily, but it would be more helpful for the economy in the long run if it was more targeted at, looking beyond just this year.
Yeah, and maybe more targeted at some of those folks on the lower end of the income scale who really have taken this much more on the chin than, folks like you, me, and Dan who are sort of white collar workers, as it were.
Right. Yeah. And there's research that shows that, people who made more than $75,000 a year, if they got stimulus checks, they didn't spend them. They put them in their savings accounts. And people who made less than that, by and large, did spend them, suggesting that maybe it was useful for those people, but not so much the others. So, I think it'll be interesting to see ultimately how targeted it ends up being.
Yeah, I hope they didn't put that money in their savings account because having a savings account is just silly right now.
Yeah.
If you got a savings account and you're watching this podcast, take your money out of your savings account, put it in the stock market. That's a joke. That's a joke. Anyway, Hannah Lang, reporter at American Banker. Thanks so much for being with us. All right, that was our interview with Hannah Lang, reporter at American Banker. And that, we talked a little bit about the Dogecoin phenomenon. Dan, I know you have strong feelings about Bitcoin and the cryptocurrency space. I actually just wrote a story this morning in the newsletter about how Bitcoin adoption, like people who have actually used Bitcoin, has increased by about 50% since just the third quarter of 2019. So that's, what is that, like 4 quarters, 5? I don't want to do the math, but it's risen from 6% of people interviewed through this data firm Civic Science to 9% of people, which is still really small, but it also means there's a lot of potential. 66% of people say they're not interested, so they're like you. They think it's a sham and a hack, but there's a growing number of people who are interested and a growing number of people who are using it. What are your thoughts on cryptocurrency now that I've said something like?
Well, I just feel like I wonder, like back if in like in the '90s there was East Coast versus West Coast rap. I wonder if there's going to be like factions splitting off between the Dogecoin people, the Bitcoin people, the Ethereum people. It's almost kind of like, you talk to people, it's almost kind of like wines or something. They get kind of hoity-toity now. They're like, no, I'm only Ethereum. No, I'm only Bitcoin. People get very...
I only invest in Dogecoin.
Yeah, that's what it kind of seems like to me. And I'm sure the average layperson, myself included, probably can't tell the difference or knows the difference. So I'm curious to know if there's going to be like, warring factions coming out, if...
Yeah.
Can one coin buy another? I don't even know how that works,
No. I don't think you can buy one coin with another. Although I think there was sort of a push for that on a platform where you could exchange your coins for other coins. But the biggest difference is Bitcoin is worth like $45,000 and none of the other coins are worth anything near that. That's the main difference.
Okay. Crazy.
Yeah, so it's like $45,000 for one Bitcoin versus I think Dogecoin is like 5 cents.
Right.
Yeah.
Something
Which,
like that,
by the way, real quick to just sort of circle, and we talked about it, Dogecoin is literally worthless. It has no value because there's no restrictions on creating it. So it can be created ad infinitum. Like you can create as much as you want. Anyone can create it and anyone can create as much as they want. So there's no supply constraint whatsoever. And it's really cheap to make. So it's literally worthless.
Whereas Bitcoin has like a finite amount, right? There's only a...
Supposedly, but yeah, I mean, the thing is, I don't know if there is a finite amount. It just is hard to make, and it takes a lot of resources to make. The same way, like, it takes a lot of resources to extract gold or to extract a diamond. So it's like the value of Bitcoin can be determined by, how much it takes to get and make a Bitcoin. But yeah, Dogecoin, anyone can just make it anywhere, and it doesn't cost that much.
So interesting.
There's that. Yeah. Sorry, and now I've forgotten, Dan. You also wanted to talk about this Rivian thing, right?
Yeah, so I read it in Bloomberg.
Is supposed to be going public.
Yeah, last night. I find these valuations just to be so crazy. And I guess Rivian, from the little bit I know about them, they're like the affordable Tesla. I guess their charger works on all electric cars, or that's like their idea for it, whereas the Tesla charger only works on the Tesla car. And I read on Bloomberg last night they're going to IPO for like $50 billion at a valuation.
Billion, baby.
It's crazy in September. And what makes me crazy, what blows my mind about this, again, as a layperson, is they don't actually have a car yet. It's all speculative. I mean, they have cars on pre-order, and I'm sure the cars are great. I'm not saying that, but it's just amazing me because, quick story, I have a friend that works in pharma. He works for a pharmaceutical company that just did an IPO. They're worth $7 billion, and they have like legitimate, proven technology that people are using, drug companies are using. I mean, you could look at a balance sheet and say, okay, these guys have something good going on here. Whereas you have Rivian at almost triple, quadruple, 5 times whatever this company is worth with no actual products on the market.
Like 7 times.
7 times. I can't even do math. It's crazy. So 7 times the value with no actual product. And it's just crazy. Same with, I think, Bumble, I think, is something like crazy too. I read too, right? The Bumble IPO.
Yeah, it's supposed to be crazy, but I don't think it's supposed to be 50 billion crazy. And by the way, I should point out that 50 billion is like the minimum. They're like 50 billion around there, but it could be more. And It probably, the way these IPOs are going, will be more. It'll probably end up being something like 55, 60 billion, maybe 65. And then the IPO will happen and the shares will like double in the first day, and then it'll be worth 100 billion by the time the first day is over. Just because, that's the kind of market that we're in.
Crazy. I mean, like, I remember when You know, again, totally different industry, but I remember when the Fairway grocery store chain here in New York City did an IPO a couple of years ago. And then I think they ended up going bankrupt as a company. But when the IPO happened, I guess you could say to yourself, I shop at Fairway. It's always packed. You know, Fairway has great specialty product. It's like a lot of fun. People like would make it a whole field trip to go to a Fairway and find, you know, peanuts they couldn't get anywhere else, yada, yada, yada. There was like a tangible thing there. And then I see this, you know, this Rivian thing, and I'm just like, I don't get it.
You don't
It's
get
crazy.
it. Part of it is just the idea of, like, the best investments that anyone makes are investments where you can't actually see the numbers where they are, because the idea is the market is an efficient pricing mechanism. So if something's worth $15 today, it's because that's what its fundamentals suggest that it's worth. And the only reason to buy it is because you believe that they're going to do way better than what you can actually see in front of you right now. So the whole point with this whole, you know, Rivian and companies like it is investors are saying, okay, this company is this now, but in 10 years, I can
Right.
see it being this. And it's kind of it's just like we're working and living in this environment where there just doesn't seem to be a ceiling, where everything can just have infinite possibility, and where like Tesla, which sells 2% of all the cars, can be worth more than all the car companies combined for some reason, because they've got some technology that's just at some point down the road going to change the world, and everyone's going to drive a Tesla. Even though no one actually thinks that's going to happen, that's what the valuation would suggest to you. And a lot of it is driven by these central banks, and it's just like people have to have a place to put their money, so they invested in stories like a Tesla or stories like a Rivian that, you know, down the road could be really big, but right now are not quite there yet.
Right.
Which actually brings me to the rant that I would like to go on.
Ooh.
Because I have spent a good deal of my time today listening to central bankers, Christine Lagarde, president of the European Central Bank, Jerome Powell, president of the Federal Reserve, say that they are not having anything to do with the inequality that's happening or the ridiculous valuations in the stock market. And it's driving me crazy because I don't understand why they won't just tell people the truth. It's like literally everyone can see it.
Right.
Everyone can see what's happening. Like
Pretty much every
stock
guest we've
market's
had
going
on the
crazy.
show has said that's what's happening. I mean, it's almost a consensus, you know.
It is consensus, except among the Fedophiles, as we like to call them, the people who ruthlessly and relentlessly defend what the Fed does, despite the clear factual narrative to the contrary. But it's like, why not just say, yes, we have increased inequality, yes, we have driven this crazy stock market bubble, but we can't really do anything else. There's nothing else that we could do. Or, you know, but it's also helped these people and done this and XYZ, right? Like, why not just say that? Why deny the thing that clearly is in front of everyone's face? Because to me, it reduces your credibility. And I don't get it. And I watched them do it again today, and my mind is blown because Christine Lagarde was being interviewed by the editor-in-chief of The Economist, and she's like, yeah, so what about inequality? And Christine Lagarde's like, oh, no, that has nothing to do with us. And it's like, what are you talking about? It has everything to do with you. You're the one making it happen. And I just like, the New York Fed actually put out a research paper, I think it was at the end of January, saying that the Fed's policies don't actually do much to reduce unemployment inequality between black people and white people, because even though a better economy does help black people get more jobs, the effect is minimal, whereas the impact on portfolio holdings, aka stocks and housing and things like that, asset prices, is significant. So that's the New York Fed saying that the Fed's policies significantly increase asset prices, and yet the chairman of the Fed continues to say that the Fed's policies aren't increasing asset prices, and I don't understand. That's
Very weird.
Anyway, that's my rant. I'm annoyed by it, but anyway, it's where we are. I think that's going to do it for the show, unless you got something else you want to rant about, Dan.
No, this is great, man. It's a very mellow show. It's good, man. You know, I like matches the weather
so
outside
mellow.
for me right now. You know, cold and dreary. You know.
Oh
Mellow
yeah,
show.
I'm here in Phoenix. The weather is it's really nice, blue skies. I think
Oh, wow.
65 degrees.
Oh, gosh.
I went for a bike ride today.
Sound like a weatherman right now. A slight breeze coming from eastern.
got a little barometric pressure coming from right over here, as you can see.
Yeah.
All right. Hey, look, thanks everybody for tuning in to Market Banter. We appreciate you being with us. This is the People's Financial Show. We can't do it without the people. From my man Dan Enfield, I am Dion Rabowen. Thanks for tuning in and being with us. Thanks to our guest, Hannah Lang from American Banker.
Yeah,
We'll catch
great.
y'all next week.